Hi and welcome to Swissquote's Daily Market Talk. It's Wednesday, May 21st. Oil rallies this morning on the back of reports suggesting that Israel is preparing to strike Iranian nuclear facilities. Safe haven assets amass capital inflows, but the US long-term treasuries don't benefit from the haven flows these days on the back of the US budget worries. So we will talk about all that and more. But before we do, please keep in mind that opinions are my own and this is not financial advice. So the US equities retreated yesterday after a six-session rally, and the US dollar weakened across the board as the sell-off in long-term US Treasuries continued on the back of difficult budget negotiations in the US about deficit spending and the giant tax cut bill of Donald Trump following Moody's rating cut last week, remember, to top it all. So the worries is that the United States won't be capable of cutting its spending enough to give away giant tax cuts, in which case the United States deficit would continue to balloon. And the problem with that is if the market, if investors, if you and I are not willing to play along and pay for that, the government, the US government could not do much to balloon that deficit. Remember Liz Truss minute budget crisis, how it did go wrong? Well, if investors say no, then it's no. For now, investors are not sold, and the US 30-year yield is just below the 5% psychological mark, the highest since 2023, and ready to spike toward the levels last seen in 2007. In the currency space, while option traders remain quite pessimistic about the US dollar's performance next year, the 1-year risk reversal, which is a metric, a gauge that gives you an idea on whether investors buy call or put options to prepare or protect against a price rise or a price fall respectively for the US dollar, has retreated to the most negative level on record on Bloomberg. It has actually never been very negative, as remember, investors are not used to hedge against their US dollar positions, against the US dollar depreciation risk, as when a global sell-off hits markets, normally the US dollar used to appreciate by amassing safe haven flows. It would basically hedge itself. But the fact that this relationship between a risk sell-off and the US dollar appreciation is no longer true means that investors around the world must seek protection to hedge against their dollar positions. So you might still like the S&P 500 or Nasdaq stocks, but you would get an FX protection when you buy them, as you probably do with your other assets denominated in other currencies. And that, in return, could eventually amplify the dollar's sell-off and the US dollar's depreciation. In summary, not only the US dollar is under the pressure of softening growth prospects for the US economy and a cautious Federal Reserve due to the rising inflation expectations for the US due to the tariffs, but it is also under the pressure of losing its safe haven status. Now, speaking of safe haven and tensions, US Crude shortly spiked past its 50-day moving average this morning on reports that Israel is preparing to strike the Iranian nuclear facilities. So far, the oil bulls haven't been successful in pushing away the bears to protect the 50-day moving average support. So the price of a barrel of US crude is back below its 50-day moving average at the time I'm talking here this morning, and the medium-term outlook for crude oil remains bearish, remember, on the back of uncertain global demand due to the trade war versus ample supply. As such, a solid resistance is seen into the $65.30 per barrel level for traders with longer horizons, opening top selling opportunities on price rebounds like the one that we saw this morning. Now, note that this is the $65.30 per barrel level is the major 38.2% Fibonacci retracement on year-to-date decline in crude oil's price, which should distinguish between the actual bearish trend and a medium-term bullish reversal. I believe that the resistance near this level will hold unless the reports materialize and the tensions in the Middle East expand toward Iran for further headache. Anyway, back to the FX markets, the rising geopolitical tensions and this global loss for US dollar, the global loss of appetite for the US dollar benefit the gold, euro, the franc and the Japanese yen among others, but these are the best alternatives to the US dollar as safe haven assets. So gold returned above the $3,300 per ounce level this morning on rising geopolitical tensions. The dollar franc is again falling by big chunks, reviving the competitiveness worries for Swiss exporters and hence rising the probability of an interest rate cut from the Swiss National Bank next month to 0%. I also suspect that the Swiss National Bank might be intervening into the 92 cents level against the euro to make sure, that the Swiss franc doesn't appreciate just too much against the single currency, which is actually the destination for about 40 to 45% of the Swiss exports. But happily, the euro itself remains relatively strong across the board with the euro dollar gaining upside momentum since this rebound off the 50-day moving average earlier this month. Trend and momentum indicators here have not turned positive just yet, and the RSI indicator is in the middle of the range, hinting that the single currency has actually room to further extend its rebound against the US dollar. Cable, on the other hand, is preparing to test the 1.35 mark this morning for the third time in the last 8 months. The stronger than expected CPI report from the United Kingdom this morning is also adding to the upside pressure this morning, mind you. But sterling remains quite weak against the euro still, and that despite the recent EU and UK breakthrough in post-Brexit trade negotiation is either because the traders actually think that the latest deal between the EU and the UK is a better deal for the European Union, for the continental Europeans than the UK, or it is simply because the euro is strengthening its position globally as a world reserve currency on the back of the US dollar's misery and loss of appetite for US dollar as reserve currency. Elsewhere, the dollar yen is also heading back toward the 140 psychological level. We're not there just yet, but the pair broke below the 144 mark this morning in Tokyo as the latest trade data from Japan showed that exports growth slowed in the month of April, while imports toward Japan fell, but they fell less than expected by analysts, which is not much surprising, mind you, given the rising trade tensions across the board and the strength of the Japanese yen during the month of April. Now, although letter hints at slower growth for Japan and could have fueled the Bank of Japan dose, that is not exactly what the pricing in the Japanese bond markets tell us. On the contrary, the Japanese yields rise on expectation that the Bank of Japan will maintain its normalization policy in place and hike its interest rates to contain the rising inflation in Japan, and the rising yields and the Japanese yen's recent appreciation are weighing on the Nikkei index that's seriously testing the 100-day moving average to the downside today. Elsewhere, equities in Europe have been benefiting from a revived appetite, however, in defense stocks of the continent, and also from the idea that a stronger euro will help taming the inflationary pressures across the Eurozone and hence allow the European Central Bank to be more supportive with its monetary policy. Now, a potential end to the Ukrainian war was also a hope at the start of this week, a hope that's unfortunately been waning with Russia's reluctance to make concessions to bring this war to an end. So Europe stays in war. Last but not least, the last 6-day rally that we saw in the S&P 500 halted yesterday, as I said before, as the Magnificent Seven stocks retreated, with Google losing 1.5%, with investors not impressed with this new AI mode, but with a company called Warby Parker rallied more than 15% yesterday on the announcement of a partnership with Google to launch series of smart glasses powered by Gemini AI. So this is all for today. I'm Ipek Ozkardeskaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments your reactions and your questions below as usual. Follow us on Instagram, on X, on LinkedIn, but also on our new WhatsApp channel, Threads, Telegram, and Blue Sky for regular market updates. Subscribe to our YouTube channel for daily market comments, and please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow, and until then, good day trading.